Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I want to start with Disney because the company named James Gorman chair of the board and said it will appoint a new CEO in early 2026. For more, we're joined by Geetha Ranganathan, a Bloomberg Intelligence Technology and a media analyst. She joins us from Bloomberg Intelligence headquarters in Princeton. Geetha, we wanted to talk to you because of what James Gorman said in his statement. Quote, "A critical priority before us is to appoint a new CEO, which we now expect to announce in early 2026. We all know what happened last time Bob Iger left, and that's why Bob Iger is back. Does this give you any indication as to who will be CEO and what their priorities will be?"
Well, Tim, no indication yet as to who would be the CEO. Of course, the one thing that it definitely does address is that succession planning continues to be the number one priority, both for investors and obviously for the company alike. So that's good news. They obviously have a very, very capable executive now running the whole process, James Gorman, who himself kind of orchestrated this really smooth transition, in his own role to Ted Pick. So obviously you have a very capable individual, but the Disney's experience with succession planning really has been so botched, and it's just been so messy. It's been dragging out so long. I mean, it's the perfect business case example of what not to do. So it's going to be interesting. I mean, we do have, many internal candidates, but they have said that they're going to look both internally and externally. So I think anybody and everybody is fair game at this point.
Yeah, it's pretty remarkable when I feel like it was, kind of Game of Thrones, I'm being extreme, between Tom Staggs
and
Jay
HBO,
Rizzo.
Carol. That's not on Disney.
No, but they were like grooming to, right? And they switched their jobs and like it just seems so logical and they were planning. Can I ask you something? Why is it taking so long to find a successor? And this isn't meant to diss Bob Iger coming back, but why did he come back?
I mean, he came back because obviously of that whole botched succession that he kind of engineered with Bob Chapek. I mean, one thing that we do have to remember is, yes, as much as we criticize Bob Iger for, all of these failed succession attempts, you do have to remember that running Disney is really, really difficult. Running Disney is very much like running a country, right? You have very, very different, disparate divisions here. The parks as its whole is just its whole animal on its own. Then, of course, you have the TV networks, you have studios, now you have a streaming product. So there are so many different elements to this, and it's really very hard to kind of find one executive who can handle it all. So right now they have all the four section chiefs. You have the ESPN chief, Jimmy Pitaro, you have Dana Walden and Alan Bergman from the TV and the studio side, and then, of course, you have Josh D'Amaro, who runs the parks. The word is that the front runners among the internal candidates are Dana Walden from the creative perspective and Josh D'Amaro from the parks perspective, obviously because that's such a critical element of the whole business.
Right.
But what they found with, putting a parks person in charge was that all of the creative relationships were completely destroyed. And we ran into a really rough patch on the studio side because of all those missteps from Bob Chapek. They are right now, thanks to, Bob Iger kind of being back at the helm, kind of fixing that one film at a time, but it has been a long and painful process. And so it's going to be really interesting because whom they name as successor is kind of going to be really important in dictating, I think, the future strategy of the company. Is it going to be, is it going to continue to be parks, or is it going to be more a Hollywood type of person, with that kind of creative element there?
Well, and we all
Mickey Mouse to do it.
actually, excuse me, maybe Minnie Mouse should do it.
Minnie can do it too. Yeah.
All I know is the creative, and you know this well, that they have been so good at taking creative and then spreading around kind of the Disney universe and making money off of it. So we shall see. Geetha, thank you so much. Always. Geetha Ranganathan, she's technology and media analyst at Bloomberg Intelligence out there at BI headquarters in Princeton, New Jersey.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So we talk a lot about insurance lately. Often involves the cost of back-to-back hurricanes, the skyrocketing cost of home insurance just generally. Even reading in this morning, there's a story in the New York Times that talked about motor vehicle insurance premiums rising more than 50% in just the last 3 years.
My dad sent that to my whole family.
Right?
Yeah.
Like, I mean, they were talking about $20,000 for a family that obviously had some kids who just started driving. But that 50% rise in the last 3 years, that's according to CPI data. We all have lots of reporting here at Bloomberg on that and some thoughts on that as well. Right now, we're tapping into the insurance world, but not the area that's gotten all that attention as of late. Instead, we're looking at life insurance, something that many Americans have or consider having. So let's get to our interview. With us right now is the Chairman, President, and CEO of MassMutual. They do provide financial products such as life insurance, disability, income insurance, long-term care insurance, and also annuities. Roger Crandall is the head of the company. He joins us from MassMutual headquarters in Springfield, Massachusetts. Roger, great to have you here on Bloomberg Businessweek. How are you?
I'm great, thank you. Good afternoon. Thanks for having me.
Yeah, great to have you here. A lot we want to get to. I have to ask you, and I know it's not your world, but our lead up, our intro into you, because you're someone who understands the insurance space more broadly, some of the trends. I got to ask, why has it that so many different areas of insurance have gotten so expensive? What do you hear from different, peers in the industry about what's going on? And I understand climate change and storms, but is there something more going on?
Yeah, well, yeah. I mean, I think it starts with something that's on all of our policyholders' minds when we talk to them about their financial plans, and that's just the level of prices and inflation over the last several years. So, you have damage to an automobile, damage to a home. It just costs more to fix it. So that is clearly part of what's happened. You had all the supply chain disruption of COVID was part of that, obviously. You've also had the situation when interest rates collapsed. Insurers, property and casualty insurers in particular, who carry mostly short-term bonds, really saw their income fall. It's only now started to go back up as the Fed has been kind of raising rates. So a little bit of a perfect storm: climate change, storms, high cost to replace, and then kind of damage on the capital side from interest rate changes as well. So we are not in that business, as you said. We're in the life insurance business, and luckily people are living longer every day. So life insurance has actually gotten more affordable over the last 5 to 10 years. So no reason for everybody not to have adequate coverage for their loved ones.
Does everyone need adequate coverage, though? And the reason I ask this is because life insurance really didn't get on my radar until I had dependents. And we hear a lot about people not having as many kids, Americans not having kids or waiting longer to have kids. If people don't have kids, do they need life insurance?
Yeah, well, I think everybody has people in their lives that matter, or causes or philanthropy in their life that matters. So I don't know a single family who has a life insurance policy pay that isn't happy to have at a time of real emotional stress, some financial stress kind of taken off their shoulders. So I think everybody should be thinking about it. And it's also one of the only things that the longer you wait, with certainty I can tell you, the more it will cost. Because the best time to buy life insurance is when you're young and healthy. If you wait till you're older, it gets more expensive. And unfortunately, if you get very ill, it can become actually unattainable at all. So I think everybody should think about having some coverage. And you can buy a policy that can be converted into a permanent policy, which is particularly effective for folks for longer term kind of objectives. So, there are 100 million Americans who either think they need more life insurance or who don't have insurance, and they all tell us one way or another they would like to get covered. So it's up to us to make it easier for them to do that and make sure that they've got financial professionals to talk to that can help them.
One thing that was interesting in my process of buying this, 7 years ago, Carol, is that there's gender differences too. So my wife and I are pretty much the same age. There's a month difference from our birthdays. But her policy is less expensive than my policy.
That's because we're stronger and better, and we're going to live longer. That's just how it comes out. I'm just going to put it out there. What's your advice to somebody, right? Like, good companies, they provide life insurance for their employees. You might have to pay a little bit into it. The difference between going that route and then just going on your own from the get-go.
Yeah. Well, I think for those of us that are fortunate enough to work for companies like Bloomberg and like MassMutual that do offer that, absolutely, I think people should be taking advantage of it at the workplace. But frequently, you may want to consider having more or different types of coverage. You mentioned disability income insurance kind of in the intro. I think that's a very much underappreciated type of coverage for most younger folks. the biggest asset they have is their ability to keep working. So that's an example of one where some additional coverage could make sense. But I think it really needs to be customized for everybody's experience. And one of the gifts that I give, I've got a stepdaughter, a stepson rather, getting married. I gave both he and his fiance a MassMutual policy as their engagement gift. And guess what? The young woman gets more. The young woman gets more coverage for the same dollars as the young man, because women do in fact live longer. Our oldest policyholder today is a woman. She's 102, and she's had her policy for 91 years. So it's kind of a remarkable how long-term insurance can be.
Yeah, I'm just going to say, like, who needs another piece of silver that you have to polish? I would take the life insurance policy. Having said that, I do want to put out, just full disclosure, that Bloomberg does work with you guys, MassMutual, in terms of offering up employees different benefits that you guys provide. So I just wanted to put that out, full transparency. Tim, I know you have another question.
Yeah, Roger, is there a better way to do this? Is there a better way to understand risk using technology and AI? I mean, when I got my policy 6-7 years ago, somebody showed up to my apartment, took my blood, did my blood pressure. But that doesn't really create an accurate risk profile of what I do day to day versus what, the other 40-something does day to day. Isn't there a better way to use tech and AI to figure out these actuarial tables?
Well, I mean, I think the answer is maybe. So certainly we can do things like be able to look at electronic health records more quickly to be able to assess risk. Because what we're trying to do is offer everybody the lowest possible cost of insurance. And that's the difference between buying an individual policy from a company like MassMutual versus what you get at work. At work, by definition, you've got to spread the risk over the entire insured kind of population. And that works really well on average. But for certain individuals, you may actually be able to get lower cost coverage by being underwritten yourself. So we are trying very hard to figure out how we can do things that are less invasive than having somebody come and take blood and other bodily fluids. That is still a very good way to assess risk. But AI is starting to change things. Maybe not as much in the underwriting. It's doing some there. Of course, it's really going to ultimately change how the business works on a day-to-day business. Our business is no different than any others. With Gen AI really beginning to make differences.
Hey, Roger, a couple things in the nitty-gritty of your business I want to ask you. You guys are a notable player in the pension risk transfer market. So basically an insurer takes on a company's pension assets and liabilities. What's the outlook for these sales?
Yeah, so at the end of the day, most companies that still have a defined benefit pension plan, and most of them are closed to new folks entering. It's not their core competency, right? It's our core competency to manage investment risk and mortality risk. So it really makes a lot of sense for insurers like MassMutual to carry that risk as opposed to an operating business that's really thinking about how to win and compete in their market kind of every day. So we see the market is going to continue to grow. The fact that equity markets have done well and interest rates have stabilized have left the funding status of plans generally in better shape. So we expect that there's going to be a fair amount of this business over the years ahead. And again, fundamentally, this is what we do every day. So we're a very good holder of that type of risk compared to the typical corporation that has to think about all their other things and not have to think about things like life expectancy, matching durations of assets and liabilities, right, and risk of their bond portfolios.
All right, but I want to kind of as a follow your own portfolio to make sure you guys meet all of these liabilities. You guys play in the private debt market. It's something we talk about all the time here sure, at Bloomberg. How have those investments performed? What can you tell us about that?
Yeah, I mean, those investments have performed wonderfully for a long period of time. I actually started at MassMutual in a training program in 1988 doing private lending, first in the commercial mortgage business and then in what we used to call private placements, and now you would call private credit. The key is you have to match the duration of your assets and liabilities. And if you have long-term liabilities like pension risk transfer or like life insurance, then you can afford to take illiquidity risk and get paid a premium. And fundamentally, what we do for our policyholders over a very long period of time, and we've paid the best dividend in our industry for 18 years in a row, is we monetize that illiquidity premium for their benefit. So you just have to really be careful that you understand your liquidity needs to match your liabilities. Really tough for someone who has short-term liabilities to do that longer-term kind of lending. But for someone like us with long-term liabilities, it really is a very nice match. So we have decades of experience in the asset class and has performed exceptionally well over time, giving us higher returns and very low losses because of the value of collateral or covenants in the case of a corporate deal.
No worry that that's topping out. I mean, as more and more, investors and folks in traditional financial establishment get into the private credit market, no worry that some of those returns and gains that you guys have benefited from, that maybe they're topping out. And forgive me, just got about 40 seconds.
Sure. Well, I worry for a living, so yes, I always
That's the
always
insurance
worry.
market.
Yeah, exactly. But I would say I think if you stick to fundamentals and follow the cash flows, there's still attractive opportunities there. There are times when there's more money coming in. There's time when there's money moving out. But we're very comfortable with the opportunities we're seeing and the quality of our portfolio.
All right, going to leave it there. Great. Look forward to, and I hope you'll come back soon. Roger Crandall, Chairman, President, and CEO of MassMutual, joining us from their headquarters.
Hey, attention New England listeners. You can hear Bloomberg Radio in and around Boston on 92.9 FM. It's your news source for business news from around the financial center of New England. Bloomberg Radio, 92.9 FM in Boston.
Yeah, and Roger Crandall, of course, coming to us from Springfield, Massachusetts.
MassMutual.
MassMutual.
I see what they did there.
You see what they did?
Yeah.
You like how that works?
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, you can find our next guest products in the dairy section of your local supermarket. Lifeway, known for its kefir. You know it. It's like that yogurt-like drink, kind of drinkable yogurt, milk smoothie.
Oh, okay. It's kind of, drinkable. Got it.
Yeah.
Sorry.
Maybe because you don't have
Critters?
young critters running around, right?
And I have older critters.
You have older critters.
An older critter.
Yeah. It's a publicly traded company, about $400 million market cap. Julie Smolyansky is the second generation of her family to run the company after her father started it and took it public a couple years later on the NASDAQ. Julie is Chairman, President, and CEO of Lifeway. She joins us from Los Angeles. Julie, how are you? Welcome.
Good. Thank you so much for having me.
Yeah, thanks for joining us. You've got a really cool story, and the company is a really interesting one because it's not often that you find publicly traded firms that have such a narrow focus in terms of products. Give us an idea of how business is right now and where areas of growth are for you.
Sure. Well, it's an exciting time to be at Lifeway. Our category is the probiotic dairy functional food space. And we are seeing just a booming explosion of business. Just the last 19 quarters have been year over year consecutive growth years for us. And that trend is not slowing down anytime soon.
Is that because of what's happening in terms of the way people think about products such as yours? Or are you doing things internally when it comes to product development, when it comes to placement, distribution, and the like? What are you attributing that to?
Yeah, I mean, I think it's both. I think, first of all, to just step back a little bit, I think people really want to know where their products are coming from, where the brands originate from. And I think Lifeway is really the embodiment of the American dream. It's just a remarkable story. As you mentioned, my dad we all came from the former Soviet Union, and we were the first of 48 families that were settled in Chicago. And, this idea of living the American dream was something my father aspired to. And when he walked the grocery stores in America, he noticed that there was no kefir, which was a staple product for 2,000 years. Something that my ancestors, my grandmothers passed down generation to generation, and it was simply non-existent in the United States. And I think that, and so that's how Lifeway was started. And then he took it public 2 years later. But I think consumers really love that heritage story. They want to know that their brand came from someplace authentic and real, not just out of an AI private equity office or something like that. And so I think that 38 years of legacy that Lifeway has been bringing to American consumers and consumers globally is part of the reason. Additionally, with this really wonderful storied product past of my ancestors knowing intuitively that kefir improved their well-being, their health. They attributed their centurion, living to 100 years of age based on their consumption of kefir. And it wasn't until 1908 when Dr. Elie Metchnikoff, did the first round of science and research on kefir and probiotics and fermented dairies like kefir. And he found that it did indeed help improve the body's health. And today, modern science is only just catching up on the microbiome, friendly bacteria, probiotics, and kefir specifically. And so there's so much exciting medical research. And Lifeway is a brand that meets the moment. We are on every grocery store shelf across the United States, from Whole Foods and ultra premium markets to Walmart and Costco. Yeah,
that's what I wanted to talk about, because I was talking to somebody recently who has a startup-ish food company. They've raised quite a bit of money and they're pretty prominent, but she was telling me how difficult it is to get shelf space at some of these prominent retailers. How do you do it as, you're not independent in the sense of a startup, you're far from it, you're a publicly traded company, but you're not Dannon by any means, you're not Lactalis. So how do you do it? How do you compete with the big players?
Well, I think they compete with us. I think they aspire to be relevant, like Lifeway is. We have been very passionate and trend setting from day one, and we still operate very nimble, and we are trend setting. We aren't just following trends, but we're creating the trends. We have been, dedicated to putting a bottle of Lifeway kefir in everybody's hand, every consumer's hand, from cradle to grave, generation to generation, and building trial, showing up at culturally relevant events. Yoga, we were one of the first brands to partner with yoga studios across the country. You can try our samples, our products at Lollapalooza, at Austin City Limits, all different, really amazing cultural moments that are relevant for consumers. And the way that we show up to our consumers, educating them on the importance of gut health, is one of the reasons why we have had such tremendous success.
So really interesting story, family story, publicly held company, small market cap, about $390 million. Stocks almost doubled year to date. Julia, I am curious though, talk us through some of the metrics, the type of growth that you're seeing: revenue, top line growth, earnings growth, cash coming in. What do you do to kind of keep growing the company?
Yeah, we have had the most incredible historic quarters. The last 5 quarters were record-breaking quarters. Like I mentioned, 19th consecutive quarters of year-over-year top-line growth. We just hit the second quarter this year. We almost hit $50 million, which has been a number we've had long circled in our aspirations. Up more than 25% this year. Our 2019 revenue went from about 93 million to almost 200 million right now, 200 million run rate. So we've doubled our revenue. While I don't obsess about the share price at all, I am very proud of the fact that in the last 5 years, our share price is up almost over 1,200%. So, these are some remarkable numbers. Our gross profit improved to a 92% increase. Our gross margin was up 290 basis points. Yeah. So this is the metrics that prove that, consumers are looking for Lifeway kefir. We are taking market share away from other brands of other types of functional beverages or other kind of old stale products like yogurt. I think we're the more trendier, fashionable, healthier cousin of yogurt.
Hey, one thing we wanted to ask you is, nifty function on the Bloomberg where you can look at, your top shareholders, and Danone North America has about a 23%. Yeah, reported that back in September. And you guys confirmed a receipt of a proposal from Danone. They offered $25 a share. You guys right now trade at $26.40 a share. Is there an offer? Is that the future that you ultimately will maybe connect with this company, Danone will own you, or is the plan to kind of keep going alone?
Well, while I can't comment on that, I would like to point to the incredible success that we're having at Lifeway. We're on a really strong growth trajectory with a really long runway. And in terms of growing both our flagship product of kefir, but also an incredible, exciting, emerging category, which is not new for us, but new for the American people, which is farmer's cheese. And farmer's cheese is so exciting because maybe you've noticed that last year, cottage cheese went viral on TikTok. And it's all over. Everyone's making blended cottage cheese and various recipes like that on social media. And our farmer's cheese is one of our legacy products that we've been making for over 38 years. It's something my grandmother's made. Like I mentioned, twaróg in my language, it's called twaróg. And farmer's cheese is exploding, and we're really excited to be growing that category. We're the largest manufacturer of farmer's cheese today, and it's going to be really exciting to scale that into all of our locations where our kefir is currently sold, and bring this new category in the dairy space. Bioavailable, high quality protein is something that consumers are really looking for and they're craving, and that's something that Lifeway's really has been pioneering and paving for a long time in the natural food space, organic food space, which is now mass market. So that's a really exciting time for us.
We only have about a minute left, but what's your product pipeline look like? Expansion beyond farmer's cheese and kefir?
Yeah, well, we are scaling our ProBugs, which is a pouched product for kids, pouched kefir product for kids that we innovated over 10 years ago, and we've really invested in some equipment and machinery to really scale that. We disrupted the entire baby food packaging space by launching the first ever pouch in the United States for kids. So we're excited to scale that into mass market. Right now, it's at Whole Foods nationwide. We also just announced the expansion of 10 exciting new trendy flavors, lactose-free. That's another big concern in the dairy space. People are looking for lactose-free products, which Lifeway offers. But they're really exciting flavors like taro, ube, matcha latte, lychee, really on trend, snackable, easy Instagrammable types of new products that we're excited to scale that nationwide as well. And then we have just like a long trajectory of new products in the pipeline, which I can't discuss just yet, but look for more things connected to skin gut access. We know that probiotics work really well on the skin or inside out. So some kind of skin-friendly products, brain gut access. Okay,
well, come back and tell us more when you can give us some of the specifics, because that's super interesting. Julie Smolyansky, CEO at Lifeway Foods, joining us from LA.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, as you know, we're just about 18 minutes away from the closing bell here on Wall Street. We talked about this with our John authors earlier, that Goldman Sachs is out saying that the S&P 500's decade of big gains is over. A Bloomberg survey, meantime, shows participants believe stocks will keep rallying into year-end, though the market is off to a slow start this week.
Come on.
What? I know.
Slow start this week. I'm sorry. The S&P 500 is up 22.5% so far this year. More than 20% gain last year. Okay.
It's had quite a run,
It
as
really
you know.
has.
We noted,
what are we supposed to do?
The weekly run.
What are investors supposed to do?
What are they supposed to do?
Yeah.
They're supposed to listen to our Drive to the Close guest. All right, so let's get to it. Miguel Sosa is head of market research and strategy at Bluerock, joining us from San Diego, California. Miguel, good to have you here on Bloomberg Businessweek. We've got Goldman Sachs saying, the S&P 500's decade of big gains is over. There is also another story on the Bloomberg about insiders selling, which is never necessarily, or is most times not seen as a positive sentiment for gains in the equity market side of things. So how do you see it right now, this environment where we've seen quite a run up in stocks?
Sure. So it's been a different environment over the last 10 years versus where we are currently, right? In the, call it the previous decade, it was a low interest environment, extremely favorable for equity investing. Now it's been, for the last 2 years or so, a persistently higher interest rate environment, which poses a potential headwind for equity investors. Nonetheless, as was just mentioned now, we've seen 20+% yearly returns both this year and last year for the S&P 500. So at the end of the day, it's probably a more challenging environment for equity investing, but who's to say the S&P can do what it wishes?
It's
Truer words have never been spoken. S&P's going to S&P, Carol.
S&P's going to S&P. Very funny. Having said that, investors do have to make decisions, and there's a lot coming at them, whether it's geopolitics, whether it's the election outcome, whether it's, I saw a story that just crossed a little while ago, Neil Kashkari maybe talking about the Fed not needing to be so aggressive. Let me just get it right here because I want to make sure I don't say it incorrectly. Neil Kashkari sees slower pace of cuts over the coming quarters. Like we've seen a bit of a reset too about maybe expectations about what the Fed will do for the rest of this year, maybe into 2025. So as an investor, what do you tune out? What do you tune into in terms of making investment bets?
Yes, it's always challenging to certainly measure and predict where the Fed is going to be. If you recall back to the beginning of, or the middle of this year, the beginning of the summer, it was higher for longer. That was the mantra. There wasn't any change to that tune. And then come July, August, there was much more moderate economic data, inflation, jobs reports, and that's when we started to hear a pivot in the messaging towards a reduction in rates. We saw that come to fruition in September with the 50 basis point cut. And now, I don't want to say another pivot, but certainly a new message of, okay, that was enough, and let's moderate the interest rate reduction. So at the end of the day, I think investors are seeing a robust and expanding economy, a healthy economy, and much more moderate inflation, which over the long term, over the medium term even, we should see a gradual reduction in interest rates. Whether it happens this year or the beginning of next year, it's going to be a slow process.
So where's the opportunity then?
I mean, you guys have what, some $18 billion in assets under management. Where are you putting investor money right now?
That's correct. And in our view, we're focused on two areas. One is private real estate. Private real estate has had a really tough run in this higher interest rate environment, but it's presenting some very attractive opportunities because valuations in real estate are down about 20%, but occupancy rates remain high. Net operating income has grown significantly over the last 5 years. So investors receive more cash flow, but at a discount because valuations are lower. And on top of the fact that interest rates, as they've moderated, cap rates have moderated as well, or cap rate increases. So we're not seeing any headwinds to real estate investing and valuation as we did over the last couple of years. So in our view, we're starting to see a bottoming in the decrease in real estate valuations there, which presents something very attractive. We're also seeing attractive opportunities in alternative credit. Also, given interest rates are higher, the tables have turned a little bit more in favor of lenders instead of borrowers.
So in terms of private real estate, where specifically? Office? Where are you finding the opportunities? And we've talked certainly around this table over the last couple of weeks, whether on surveillance. Last week we had a great guest, David Steinbach over at Hines, talking about that as deals get done, you get some transparency, right, on where the pricing is in the market, right? You get some clarity about that. But I am curious, when you're talking about private real estate, where are the opportunities for you guys?
Yes, we're staying away from office. Office has faced a challenging last several years, 5 years, and it will continue to be challenged. And in Bluerock's view, we like to think of it as under demolished, actually, because there's still some pain to go through there. But in our view, we like the industrial sector much more. There's persistent and structural benefits within investing in that particular sector because more of us continue to buy more products online, and we wanted those products delivered to our homes faster than ever. So that changes the demand for the warehouses that hold those products. those warehouses have to be closer to where we live to get those products faster to our homes. And so that's creating a very, very persistent growth in demand for industrial and specifically logistics warehouses and last mile facilities. We also like the specialty sector. Specialty is really a catch-all term for everything that's not under the big four real estate. So you can think of specialties such as single family rentals, data centers, life sciences. And these are exciting subsectors because there's little to no correlation to the overall economy. A simple example, think of data centers. We're all consuming data on our phones. We will continue paying our phone bills and our internet bills, regardless of whether it's call it expansionary periods or recessionary periods. And so it's become a part of who we are and a necessity, right?
Hey, before you go, just got about 30, 40 seconds. I got to ask you, because private credit is your other world. And again, everybody seems to love private credit. We hear about it being kind of the golden days of private credit. PIMCO, our Bloomberg Intelligence Credit Edge podcast had PIMCO on, a PIMCO guest says, private credit doesn't pay as the hazards grow. Are you seeing any signs of an overheated private credit market? And forgive me, there's just about 25, 30 seconds left.
Sure, not really. We are seeing yields come down a little bit in the private credit space, in the very small middle market loans. In the area in the spectrum where we participate, broadly syndicated loans, there's still very healthy transactions, healthy yields there. And so no need for concern there or any bubble in terms of private credit.
All right. Got to run. Hey, listen, Miguel, thank you so much. Miguel Sosa, head of market research and strategy over at Bluerock. They've got about $18 billion in assets under management. As you said, private real estate and private credit are the two investment strategies that they work with. And joining us there from San Diego, you are listening and watching Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.